Welcome to this deep dive, and this one's really tailored for you, our listeners, right here in Houston. We're tackling a pretty important topic today, how your local business might unlock some, well, significant tax savings.
Yeah, it's the crucial stuff. And our insights today, they're coming straight from the folks at SAS Tax and Business Solutions right here locally.
Yeah.
We're really honing in on one key strategy, getting depreciation right for your business assets.
Depreciation, okay, sounds a bit accounting heavy, but you're saying it's important for, say, a restaurant owner or a construction firm here.
Oh, absolutely. It might sound dry, but trust me, understanding depreciation, it's a really powerful tool to lower that tax bill and, importantly, improve your cash flow. SAS Tax really emphasizes this getting it right matters a lot, especially in Houston.
Okay, so let's break it down. What is depreciation really? Imagine I just bought a new delivery van for running up and down I-10, or maybe a big walking cooler for my seafood place near the Gulf. How does it work?
Perfect examples. So that van or that cooler, it won't last forever.
Right.
It wears out. It depreciates. Depreciation is just the tax system's way of recognizing that wear and tear on your business assets, vehicles, equipment, even buildings over what's called their useful life. Instead of taking the whole cost hit in year one, you spread that deduction out. Think of it like the tax code acknowledging the van loses value with every mile you put on it.
Got it. So it's not about cash out each year specifically, but it reduces the income I actually pay taxes on.
Exactly. And that's the key benefit for you as a Houston business owner. Lower taxable income means a lower tax bill. And lower taxes mean, well, more cash in your pocket after taxes.
Yeah.
That's cash flow you can use, hire people, expand, maybe even beef up your hurricane preparedness fund. You know how it is here.
Right, that makes sense. SAS Tax mentioned it's a potential game changer for certain industries that are big here. Which ones should really be leaning into this?
Definitely businesses with significant investments in physical things, tangible assets. So think construction, obviously huge in Houston, all that heavy machinery. Restaurants, too. You know the scene here. It's competitive. Lots of expensive kitchen gear, medical practices as well, all the diagnostic tools, furniture. For these kinds of capital-intensive businesses, really nailing depreciation can mean freeing up serious cash for payroll, upgrades, just staying resilient.
Okay, now SAS Tax highlights a couple of ways to maybe supercharge these deductions. Section 179 and bonus depreciation. Tell us about those.
Yeah, these are the accelerators, you could say. Great tools to potentially get bigger deductions sooner. Let's start with Section 179, expensing. So for 2025, you can potentially choose to deduct immediately up to $1,250,000 of the cost of qualifying equipment, new or used, which is nice. There's a catch, though. That benefit starts phasing out if your total equipment purchases go over $3,130,000.
So it's really aimed more at small to medium-sized businesses, making bigger but not enormous investments.
Generally, yes. It's great if you're buying new computers, maybe upgrading machinery in your workshop, or like that delivery van example. Allows a big write-off right away.
Okay, big upfront deduction.
Yeah.
And bonus depreciation. How's that different?
Right. So bonus depreciation for 2025, it lets you take a 40% deduction in the first year on qualifying assets. Now, this is important. The 40% is set to drop to 20% in 2026, and then it's gone after that. So there's some urgency there.
Ah, okay, a declining benefit. And bonus is better for bigger things. You mentioned real estate.
It often works well for larger asset buys, yeah. And it's particularly powerful when combined with something called a cost segregation study, especially for commercial real estate.
Cost segregation. Sounds technical. Quick explanation for someone owning, say, a warehouse or maybe a medical building in the med center.
Sure. So you own the building. The main structure gets depreciated over a long time, like 39 years. But a cost segregation study, it's an engineering-based study that breaks down the building into smaller components with shorter, useful lives. Think about things like specific wiring for equipment, maybe carpets, even outdoor lighting for the parking lot. These things don't last 39 years. You can depreciate these shorter-lived components much faster, maybe over 5, 7, or 15 years. And crucially, you can often apply bonus depreciation to them.
Ah, so you pull those deductions forward significantly.
Exactly. SAS Tax points out this can lead to potentially six-figure tax savings up front for Houston businesses owning commercial property. It's a powerful strategy.
Wow. Okay, so Section 179 versus bonus. If I'm looking at both, what are the main things to weigh up?
Good question. Key differences. First, flexibility. Section 179 lets you pick which specific assets to expense. Bonus, it generally applies automatically across the board to eligible property. Second, taxable income limits. Section 179 can't create a business loss. Your deduction is capped by your profit. Bonus depreciation can create or increase a loss.
That could be important depending on the year's performance.
Definitely. And one more thing for Texas businesses. Both of these strategies, Section 179 and bonus, they reduce not just your federal tax, but also your Texas franchise tax. So double benefit there.
Good to know that state impact. Now, are there common slip-ups? Mistakes SaaS tax sees Houston businesses make that cost them money?
Oh, absolutely. Plenty pitfalls. A big one is just using the wrong asset lives.
Mm-hmm.
The IRS has specific recovery periods for different asset types. You can't just guess. Computers aren't the same as furniture, for example.
Yeah.
Another one often missed, leasehold improvements. Say you spend a lot fitting out your cool new cafe space in Montrose. That build out. It often qualifies for faster depreciation, maybe 15-year property, and could be eligible for bonus depreciation too. Don't just lump it in with the building.
Okay, details matter. What else?
Forgetting the paperwork. You need to file Form 4562 to claim these deductions. Sounds basic, but it gets missed. And record keeping, just poor records. You need details. What you bought, when, how much, serial numbers if possible. Just writing machinery various on your asset list, that's not going to fly in an audit.
Noted. Vague is bad.
And finally, depreciation recapture. When you sell an asset you've depreciated, you might have to pay back some of that tax benefit as ordinary income. You need to track that properly.
So lots of places to potentially stumble. It sounds like getting some help might be smart. How does SaaS Tax and Business Solutions step in for Houston companies here?
Well, they have a few ways. They use specialized fixed asset software, often integrated with their accounting services, which helps track everything accurately, the purchases, the calculations. Takes a lot of guesswork out. They also offer outsourced CFO services. Their CFO Basic package, for example, can help model out the cash flow impact. Like, okay, should we do Section 179 this year or rely on bonus? They help you make informed decisions.
So they help with the strategy, not just the compliance.
Exactly. And they also work with startups. Getting these depreciation policies right from day one, that can save a lot of headaches later on.
Makes sense to start off on the right foot. You mentioned the timing earlier, especially with bonus depreciation changing. What's the real cost of delay for a Houston business not sorting this out soon?
Well, the biggest immediate thing is that shrinking bonus depreciation. 40% in 2025, then 20% in 2026, then gone. If you're planning major asset purchases, waiting could mean leaving serious money on the table. Simple as that.
So you pay your taxes sooner than you might have to.
Right. Less cash flow available now. Plus, if you've been doing it wrong in prior years, fixing it later can be complex, maybe even involve penalties. And like we touched on, incorrect depreciation can inflate your Texas franchise tax too.
So the clear message for everyone listening in Houston is don't just treat depreciation as like an accounting afterthought. It's a real strategic opportunity.
Absolutely. It can directly impact your bottom line, your cash flow, your ability to grow. And with bonus depreciation stepping down, 2025 is a particularly important year to get proactive.
Okay, a final thought then for you listening. How could really digging into your business assets, understanding these depreciation rules we've talked about, maybe unlock some unexpected financial flexibility for your business this coming year? Definitely something worth exploring, perhaps with guidance like that offered by SaaS Tax and Business Solutions. Thanks for joining us on this deep dive.